everyone. We are continuing our series here at Sharp Trade on money management for investing and trading. There is one thing I would like to say, sort of carrying over from the last video in this particular series that we have. And we were talking about risk and where a person will accept a loss for their account and figuring out, okay, how much am I going to consistently accept for a loss? What would be the size that I'm okay with losing? Understanding that you can get into a series of losing trades. It happens to everyone. Well, if that happens, figuring out the position size. There's one other risk that we would like to mention when it comes to that, and that is market conditions. So you also have to figure for market conditions. In other words, there are some markets you can trade and you may not be able to get out when exactly you want to get out. That is another risk of trading. So in that case, what do you think you would do? If you know you're going to be trading in markets and you may not be able to get out when you want to get out, how would you control your risk in that situation? Well, wait a minute, Dan, I can't control my risk because I can't, and there are situations where I can't execute an order. It's going to open up big, and it's going to open up big against me. Sure, there's things you can do. You can lessen your position size. See, always be thinking about how to mitigate the risk. So we just wanted to say that from the last video in this series. Now, we've been talking risk. And we have to, because that's where successful trading starts, is identifying the risk. But risk is in a marriage, okay? Risk is married to reward. They are husband and wife. There's no separating risk without reward, reward without a risk. If you're looking for a reward, well then risk is going to accompany that. So we need to say at this stage in the game that there's also the reward. So let's talk about that. All right, that's what I've wanted to talk about this whole time. This far into the series, and we haven't been talking about profit yet. Well, we're going to do so now. Remembering that those two are married together, risk and reward. Usually, in the topic of money management, by this point, if a trader has sort of digested the ideas that we've talked about today, they generally run into a problem. Now, for years, what I said in the previous series that I had done, this particular topic of money management, in the previous iteration of this series, I said that a trader could get into the problem of nickel and diming themselves to death. Just small loss after small loss after small loss. I heard another trader put it more poetically, they die the death of 1,000 cuts, right? That's what we said on the last video, is that they die the death of 1,000 cuts. In other words, they're willing to accept their loss, and that's good. You need to be willing to accept their loss. So many traders start off and they're not. I'm not going to accept the loss. I'm not going to accept the... Just accept it, make it small, and make it quick, right? But the problem is, and what will start to happen, is they get used to doing that. I'll just take my loss. I'll just take my loss. I'll just take my loss, right? They could nickel and dime themselves to death. So you do need to understand that risk is married to reward, right? They're husband and wife. And you need to look at this, as we had said, as a series of trades. Because money management deals with how is your performance after 10, 15, 20, 30 trades, 50 trades, 60 trades. Okay, so in a whole series, that's what money management has to do with that series of trades. You're going to have some losses. What do your profitable trades look like? Now, earlier we had said that risk was married to reward, their husband and wife. So what we want to say is, what do your profitable trades look like in relation to your losing trades? That is a critical element. Backing up just a little bit, as we were saying, we find that sometimes new traders would just accept their loss too quickly. They just start getting out of trades and accepting their loss, and that's good. But they also get out of profitable trades much too quickly. I'm just going to go ahead and say that most traders have that problem starting off. I did. Something that might be able to help is a concept that I talk about that's I refer to it, I just came up with this name. I don't know if other people have a different name for it. I refer to it as a break. Okay? A break, in other words, something that puts the brakes on from me doing something stupid and jumping out of the trade, too quickly, simply because I have a profit. So it's just some sort of technical tool that once I'm in the trade and it's moving my way, if that technical tool for that time frame isn't violated, well, that tool is my brake. In other words, it puts the brakes on me doing something stupid and jumping out of the trade too quickly. So that just might be a concept, a particular concept that might help, and so that you make sure your winning trades, you get as much out of them, you get as much out of your winning trades as possible. But remember, this is dealing with a series of trades, and if we're talking about 20 or 30 trades, what does your profit look like? Your average profit. Take all your profit, take all of your losing trades. What does your average profit look like in relation to your average loss? This is where the math of profitable trading begins. Let's illustrate this.
Now, in previous versions of this money management series, we would talk about money management, and many times when we're speaking about money management, a lot of the context of the conversation really revolves around short-term trading. It doesn't need to. For some reason, the conversation always seems to go that way. But it doesn't matter if it's a longer-term investment. It doesn't matter if it's a short-term trade. It doesn't matter if it's a swing trade, day trade, whatever. You will have a position size. Right? If you're day trading or you've got a valuation investment, there's a specific position size to that. There's a moment where you buy it and you make your position size, whatever your equal position size is, and then an area where you think, okay, I'm up 40%, or I've made a few basis points on this day trade and I'm willing to get out. So although sometimes the context of the conversation, we sort of always talk about 20 or 30 short-term trades, it applies to longer-term investments as well. Remember, these are principles. Principles you can apply in a variety of situations. So any trades or any investments, okay? Now we remember, as we were saying before, that risk is married to reward. Well, at the same time, we would say that there is a balance between risk and reward. You never want to take on too much risk so that it doesn't even make sense to be in the trade or to be in the investment, because there's far, far too much risk involved. Because remember, we're talking about a series of trades, right? So just a general principle and a general way to think about it. Remember, we're speaking in principles. And there's a reason why I keep on saying we're speaking in principles, we're speaking in principles, we're speaking in principles. Because every once in a while I would try and make this very simple, very basic, very clear for folks who are new, because these are introductory money management concepts. I would try and make it very basic for folks who are new. A professional would run across this and say, this guy, knows about a risk-reward ratio, thinks he's got trading all figured out. It's like, oh, for pity's sake. So we're trying to make this simple and clear, okay? So that's why we keep saying general principles. But as a general principle, you want your average risk, whatever it is, to be light. You want or would be looking for a larger reward. So the reward outweighs the risk. So, as a general principle, let's think of terms of like one risk, very light, you could lose, there's no guarantees, but to two reward. Okay, so another way to illustrate this is, okay, you're going to go into a series of trades. When you lose, you're going to lose $1. When you win, you're going to win $2. As a general principle of the way to think about risk-reward. Now, when you think about risk-reward in this manner, that is known as the risk-reward ratio. That's the concept that you really want to carry away from this video. You need to understand what your risk-reward ratio is. It also means that you'll be needing to keep track of all of your trades or all of your investments. When you win, how much do you win? When you lose, how much do you lose? Now, we illustrated it with the concept of, okay, when I lose $1. When I win $2. Some even I'll win $3. I risked $1 and I'll make $3 on a trade. Remember, that's a general principle. You don't need the risk-reward ratio necessarily that heavy in that direction. In other words, 1 risk to 4 reward. That'd be great because that's also known as basically just printing money. That'd be fantastic if you could. But you do need to know what your risk-reward ratio is. You do need to be recording all of your trades. How much did you win? How much did you lose? And then the average of all of the losses and the average of all of the wins together will make up your risk-reward ratio. And you will need to know that. It's a very powerful concept. However, knowing your risk, knowing how much you make when you generally make, knowing your risk-reward ratio is one part of the equation. Okay, it is one part of the money management equation. I've seen educators out there who've tried to sort of reinvent money management, and I don't really understand that. And they'll speak, well, you can just simplify it all and just speak in this term or that term. And no, you need to be thinking about these as separate concepts. Some have even tried to reinvent the term, just position sizing. Well, position sizing is only one aspect of money management. One. And you will see how all of these things fit together as we move forward in this series. Because the risk-reward ratio ties to another piece of the triangle, which we'll talk about in the next entry. But for now, that has been what it's always been. It's simply been our thoughts, not yours, for whatever the heck day it is. As always, stay safe, trade well, and remember that love doesn't cost a dime.